If you look at that move from $4 silver up to 50, that's about an 1100% move. Let's just call it 10x for easy math. 10x on 50, that gives you a log scale target of $500 silver. And I think gold is doing a fantastic job of doing that. Ultimately, ultimate price target, $15,000 gold. I think that's just based on an average of the previous two bull markets.
Is it any wonder that gold and silver keep going up? That's why I've always said, hold on to your gold and silver for dear life. There will be no savior, I guess, for fiat currency. You can try to save yourself financially with gold and silver.
Renowned economist and global strategist Steve Penny outlines a staggering bullish case for precious metals based on historical logarithmic moves. He highlights silver's past explosion from $4 to $50, an 1100% gain, and argues that applying this same 10 times math to the $50 level yields a log-scale target of $500 per ounce. For gold, Penny projects a long-term price of $15,000 based on the average gains from the last two major bull markets. He contends that the relentless ascent of these assets is simply a reflection of a dying fiat system with no savior in sight. Penny urges investors to stop waiting for a pullback and instead hold their physical gold and silver positions, for dear life, to survive the coming currency collapse. If you found this analysis helpful, make sure to hit that like button, share it with fellow investors who follow gold and silver, and subscribe so you don't miss the next big update.
Having those different buckets, as I call them, has really helped to kind of relieve the emotional burden of trying to navigate this market. Like you said, I've got some physical metal, not selling. I've got another basket of physical metal that I'm going to swap for ratios when they dictate. Not really near those levels yet. And I've got a long-term account of just top-tier quality mining stocks that I've emotionally decided ahead of time I'm not selling till near the end of the bull market. Don't think we're anywhere close to that yet. Then I've got what's called a volatility advantage bucket. So I give myself permission to sell. So, back in October, I'm not sure if we spoke before then or not, but we had sold all of our positions in SILJ, the Junior Silver Mining ETF, and the URNJ the day before the peak. A little bit of luck involved there. I don't claim to be able to time, exact peaks of the day before, but we fully exited those positions, looked for the pullback in silver. We pulled back to about 45 in silver. We began redeploying capital, and I thought that consolidation would be a little bit longer. But the day that we broke above 54, the day after Thanksgiving, that was my buy signal. And, I thought we were going to have a little bit more time, but we went ahead and bought on that day, on that breakout, and that's worked out really well for us. So we have that, having that volatility advantage bucket is kind of nice. It gives you the emotional bandwidth. Hey, I'm going to trim some profits here, and it's okay. I've decided ahead of time, it's okay if I sell and it keeps going up. Or, and it gives you permission to kind of use volatility to your advantage while capturing the long-term gains in a long-term account. I do. I've got a few, and that's where it gets really fun. So I've got probably 5 or 6. I won't go through all of them because it might be kind of boring, but the big one, I mentioned 1979. We were overbought at $16, and then we had the big run in 3 short months. We went from 16 to 48, basically exactly a 3x move. Well, this move began, the really parabolic phase began when we broke through 54. Times 54 times 3, that gives you 162. So that would be a replica of the 1979 3-month move that we had, 162. I think that's the higher end of the potential target. Not necessarily predicting that, but that's the high end. Now, where it gets really fun, and I want to be careful because I don't want to be the guy that says we're going to $500 silver this year. I take kind of a one step at a time approach. However, using 96 is the measured move target using a linear scale. But if you look at that move from $4 silver up to 50, that's about an 1100% move. Let's just call it 10x for easy math. Well, 10x on 50, that gives you a log scale target of $500 silver. I think that's realistic. Not this year, probably not, maybe next year, but I think in the next 2, 3, 4 years, that is possible. It's certainly possible. And, what I don't want the takeaway to be is for people to say, I'm going to hold all my silver till 500 and then sell it all because maybe we don't get there. But I do think it is a realistic target, and scaling out along the way, is a useful kind of thought exercise. Gold has just been on a tear as well, but gold is kind of seems boring. I mean, it's only going up, 10% a week instead of, I'm kind of kidding, but yes, so gold is on a really nice move. It's it's closing on $4,700 as we speak. It's moving so fast. Is it above $4,700? It's right at about $4,700 on gold. Mindset wise, here's how I think about gold. Gold, I think about capital preservation. Where silver, platinum, mining stocks, I want capital appreciation. Now, I think gold will increase your purchasing power over time, but that's not my mindset. I'm thinking, I just want to preserve my purchasing power through all the uncertainty in this world. And I think gold is doing a fantastic job of doing that. Ultimately, ultimate price target, $15,000 gold. I think that's just based on an average of the previous 2 bull markets. Doesn't mean it's not going to be a wild ride on the way there. So, yeah, I really like gold now. And by the way, the gold silver ratio has come down from 108 to 1 in April of 2025 to 50 to 1 now. So silver has outperformed gold by 2x, even though gold has gone up. So, ultimately, I think that gold silver ratio is going to go lower. I think silver is going to outperform. However, if you're worried about a pullback and you don't really want to ride through that and maybe you want to de-risk, like for me, I was like 90% exposure to physical silver and only about 10% gold. So what I've been doing, even though I think silver is going to outperform over the long run, I've been taking some silver, swapping it back for gold. And that way, if we get a pullback, gold will still go down. They'll probably just go down less. But if we keep running higher, yeah, gold will still keep going up, but it just won't go up as much as silver. So it's a way to just kind of de-risk, manage your emotions, and something just to think about.
The investment strategist outlines a disciplined bucket strategy designed to neutralize the emotional burden of a volatile bull market. By segregating assets into long-term physical holdings, ratio swap baskets, and a volatility advantage bucket, he actively trades peaks, successfully exiting SILJ and URNJ positions before the October correction, while keeping core positions intact. With silver recently shattering $54 resistance, he projects an immediate parabolic move to $162, replicating the 1979 breakout, while eyeing a logarithmic long-term target of $500. Conversely, he views gold primarily as a capital preservation tool, destined for $15,000, using the compression of the gold-silver ratio, now down to 50 to 1, to de-risk by swapping overperforming silver back into the yellow metal. Let's get into the interview.
Gold and silver have certainly continued to do really well. Overnight, gold traded up to almost 4,900 and silver traded up to 95.58. So what I want to talk about today is when am I going to sell my gold and silver, right? I'm sure a lot of you are thinking of that. A lot of you want to ask me that question. And my answer will be a little unexpected, I think, or maybe not. And why do I say that? I'm not going to sell it. And in future, what gold and silver are going to be, like Ray Dalio said, it's going to be the ultimate storeholder value. It's not going to be fiat currency anymore or fiat debt, treasuries or bonds or JGBs or gilts. It's going to be gold and silver. So there will be a brave new world, if you want to call it, where you exchange your gold for other assets at a certain ratio, and that will be the price, right? I'll give you an ounce of gold for, 10 acres of land in somewhere, right? Or I'll give you an ounce of silver for 2 dozen eggs. I don't know, that's what it's going to be like. And you might think, oh, but we're used to the prices in fiat dollars. Well, I can tell you, having grown up in a place like Brazil where the currency changed so much, where the currency collapsed and you actually use the dollar really as a storeholder value there, you get used very quickly to valuing things in different currencies. And that's the world we're going into. Of course, for people who are totally oblivious to the fact that the Titanic, the monetary Titanic, is sinking, well, they're going to stay in the Titanic. They're going to go into the casino in the Titanic. I don't know if they had one. And they're going to keep gambling in the casino. They're going to keep buying gold futures, doing options, and so on and so forth. And yeah, for them, I hope they have a little bit of physical on the side. And Ray Dalio actually said that in the neutral portfolio, you should have 15 to 20% gold neutral. So he didn't say, I think, how much he has of gold, but he basically said he's got half gold, half tech ventures. That's all he has, it seems. So what else is going on? I did tell you I'm going to keep it short. Well, we had some UK CPI numbers. They call it inflation, of course. It's more like prices. UK CPI came out at 3.4%, so it's risen from 3.2%. So if you look at the UK gilt yield, the base rate in the UK is 3.75. So you're getting nothing really for your money if you put it on deposit, your fiat currency. We've got financial repression. Basically, they are taxing you through inflation. And that 3.4 number is more like 5%, I would say. I did a video back in July of 2022 about how the Office of National Statistics in the UK, they flagrantly switched the history of CPI going back to post-World War II. And basically, they made it look like 1% less. So have a look at that. So that's why I'm saying 3.4 is more like 4.4 or even 5. I wouldn't be surprised. And there's another measure of price in the UK that used to be follow, not as big, the increase. And they still publish it. It's called the RPI. And that came out at 4.2%. So is it any wonder that gold and silver keep going up? Because the smart money, like Mr. Dalio, they've realized that fiat currency and the debt that backs it are not a good storeholder value anymore, and that the monetary order is breaking down. And he notes that the biggest buyers were the central banks last year, and they're going to continue to buy this year. They started buying aggressively in 2022. They did it in 23, 24, 25, and they're going to continue forward until they have probably more than 60 or 70% of their reserves in gold. I saw that Poland announced yesterday or the day before they're going to increase their gold reserves by 150 tons from 550 to 700. So there you go. That's why I've always said, hold on to your gold and silver for dear life.
Financial analyst Marioinnecco addresses the burning question of when to sell gold and silver with a defiant answer: never. He envisions a future where precious metals cease to be traded for fiat currency and instead become the direct medium of exchange for tangible assets, where an ounce of gold buys land, not depreciating dollars. Innecco compares the current financial system to a sinking monetary Titanic, warning that while oblivious investors gamble in the ship's casino with futures and options, smart money is securing lifeboats. He cites Ray Dalio's pivot to gold as the ultimate store of value and points to aggressive accumulation by central banks, such as Poland's addition of 150 tons, as proof that the smart money is exiting debt. With UK inflation metrics like RPI flashing 4.2% and real yields negative, Innecco argues the only safety is to hold physical metal for dear life. If this gave you value, smash that like button, share it with those paying attention, and subscribe so you don't miss what's coming next. Stay alert, stay prepared, and keep stacking tangible assets.